Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss avoiding stock market crisis with margin debt data.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I would like to show you a very interesting market trading strategy that's built on a dataset from FINRA. The dataset is about the margin debt and the amount of margin debt in brokerage accounts. And we can use this dataset to time the S&P 500 indexes or equity indexes. So firstly, what is the market timing strategy? So the market timing strategy is a strategy in which you select one individual market, the overall commodity market, gold, treasuries, or in our case equities or US equities in the form of S&P 500 index, and then you are trying to find out optimal time to enter the market and optimal time to exit the market, that you have a interesting performance and you have a small drawdowns that's just buying and holding the market. So that's the market timing strategy. We have a lot of them in our database, approximately 250. The video is based on our article, Can the Margin Debt Help Predict SPI's Growth and Bear Markets? I mean, the main reason for that article was the uncertainty that's surrounding the Trump's presidency. We can expect that there will be a lot of the growth and then a lot of the bear markets over the next few years, because there will be like a lot of the volatility and stress on the market. So maybe it's not a bad idea to have a trading strategy that can serve as a warning system, and the margin debt data can be very useful for stuff like that, because strategies that are built on the margin debt data are different from the strategies that are based on the price data alone, and you can mix those together, and I mean we have a better trading strategy, better market timing strategy, and I will show you how to do that in the video, and it's also in our article. Firstly, where we can find the data. So we can find the data about the margin statistics on FINRA webpage. So the webpage is in the description of the video, and here we have FINRA statistics shown in millions of dollars. We can easily download those data, and data are usually updated once in a month with 1 month lag. So as we can see, today is March, and we have data for the end of the January. So plus or minus in the middle of the March, we will have data for the end of the February. When we will build the trading strategy, we need to understand these limitations so that we have 1 month lag about the data, but still the data are very useful, even with the 1 month lag. Why we want to use the margin debt data? I mean, borrowing to invest is very common strategy, and it can amplify both the returns and also the risk in the financial markets. And the margin debt is a key measure of this leverage. So I mean, the margin debt is the total amount investors borrow to buy stocks using their holdings as a collateral. So what does it mean is that increasing the margin debt often signals rising investor confidence. So the investors are more willing to take risk, and this can drive prices higher, of course. On the other side, decline in the margin debt may indicate risk aversion. So also deleveraging and market stress, and this can potentially lead to lower stock prices. Because the margin debt is very sensitive to the risk appetite of the investors, we can use this data set to try to pick when to invest into the market and when to invest into something safe like cash or very short-term bonds. So we have data, the margin debt from January 1998. So it means we have plus or minus 26, 27 years of data, which is fine, which is enough to build a trading strategy. Here we have how does it look like. This blue line is the performance of the S&P 500 or SPI ETF with the dividend and splits adjusted, so total return. And the dark blue line is the margin debt. As you can see from the visualization, the local peaks in the margin debt occur at the same time as the local peaks in the SPI, so in the US equity index. However, and this is important, from time to time the margin debt peaks precede the SPI peaks by a few months, and this is important. So we can use the margin debt info as a market timing signal, because from time to time the peak in the margin debt is sooner than the peak in the SPI. So we can try to build a market timing strategy. So what we started is that we decided to build it using the simple moving average. That's a very simple way how to build a market timing strategy, but firstly we need to build the benchmark. Why to build a benchmark? Because if you want to compare whether the strategy is good or not, we want to compare it to something. So what we did is that we build the benchmark, we build the trend following strategy using SPI, using only SPI prices, and those trading strategies or this trading strategy or average trading strategy using just prices is our benchmark, and we hope that the market margin depth strategy, we'll have a better risk return ratios, better performance, etc., etc. So we want to improve on our strategy that uses just prices or SPI prices. Because I mean, if it doesn't outperform the SPI alone, or trading strategy that uses just SPI prices, I mean, why to work with the margin depth? I mean, it's just a lot of the work and I mean, no added value. What we did is we ran a simple trend following strategy, which works in a way that if the price of the SPI is higher than its moving average on a monthly basis, we will buy SPI. If it's lower, then we will hold the cash. And we have one degree of the freedom. We have one parameter. So what is the length of the moving average? And for that length of the moving average, we tried every combination from 3 months up until 12 months. And then we averaged all of the strategies together, and we compared that average strategy to SPI, to just buying and holding SPI itself. As we can see, we have our strategy has a better performance, lower drawdown, lower volatility or standard deviation, a better Sharpe ratio, a better Kalman ratio. So just using the moving average on the price, just simple trending or trend following strategy on SPI has better ratios than buying and holding SPI itself. But that's something that all of us know. So what about the margin depth? So then we took the margin depth data, and once again we ran the moving averages from 3 months until 12 months, and we checked what is the performance of the strategy that uses that moving average as a predictor. So if the margin depth is higher than the moving average of the margin depth itself, we will buy the SPI, otherwise we hold the cash. Once again, the margin depth data is typically released with a 1 month lag. So it means the buy signal is based on a month-old values. We must understand that it's 1 month lagged data we are using. So when we calculate the moving average signal from the margin data, we use April as the last data point for the calculation, and we run the calculation at the end of the May, because the FINRA usually distributes the April's data in the second half of the May. So how does it look like? Once again, the blue line is the SPI itself, buying and holding. The green line is the average of all of the trend following strategies itself. So what we have, once again, we have a better performance, a lower drawdown, a lower standard deviation or volatility, a higher Sharpe ratio, and a higher Kalman ratio, which is performance compared to the maximum drawdown. What is the most important thing is that the risk return ratios using the margin depth as a predictor are higher than using just the price alone. So if I compare the results in this table to the results from this table, the average trend following strategy based on the margin depth has a better risk to return ratios than just using the price alone. It means that maybe the margin depth data are useful and we can use them. In the next step, we combine the price trend and margin depth trading strategy. So we try to build a combined strategy that uses also the price-based signal and also the margin depth signal. So what are the trading rules? So for each moving average period of SPI, we assign the corresponding moving average of the margin depth with the same period. If we use 3-month period for a moving average of the price, we also use the 3-month period for moving average of the margin depth. This way we simplified the test. So with this approach, we created 10 new indicators, the 3-month average of SPI combined with the 3-month moving average of the margin depth, etc., etc. So our trading rules were that if the margin depth is higher than its moving average, 8-month moving average, and at the same time price is higher than the 8-month average of the price, then we buy SPI. In other cases, if just one price is higher than moving average or margin depth is higher than moving average, but other no, in this case we hold the cash. So both indicators or both predictors must show us that it's safe time to buy the SPI, safe time to buy the stocks, and then we buy the stocks. If just one of them is showing us we should buy the SPI or stocks, we are holding the cash. So both of them must give us risk on a signal. Okay, what is the performance? Once again, higher performance, lower maximum drawdown, lower standard deviation, higher Sharpe ratio, higher Kalman ratio, then, SPI alone, or then just using the price or using just the margin depth data. So when we combine both of them together, it's significantly better. Okay, so what is the final model? So what is our recommendation is not to use all of the averages from 3 months until 12 months, because what we can see is that especially the shorter part of or shorter strategies like 3-month, 4-month and 5-month moving averages are not performing so well. So it's better, to use the moving averages that are in the medium term, like from 6 to 12 months. And then we have a question. So should we pick just one strategy or one parameter, like let's buy when the margin depth is higher than its 8-month moving average and at the same time the price is higher than its 8-month average? Or should we use 11 instead of 8, 6 months instead of 8? So in this case, what is our recommendation is to use like average of all of the models. So our recommendation is use all 7 models, so all 7 moving average from 6 months until 12 months. Divide your portfolio into 7 parts, and each of those parts will be managed by only one moving average. That's in this case, if there is a change in the future, so I mean not the 8-month moving average is the best, but the 6-month or 12-month, you will not have a bad luck. So you do not rely on the luck, but you rely on the statistics. So I mean in this case, when you divide your portfolio into multiple tranches and you trade each part with the individual moving average, with the individual model, your portfolio is diversified and it's significantly more stable. I mean, if you want to know more about the theory, why to do that, we have a perfect article about that. It's called How to Choose the Best Period for Indicators. And in this article, we are exactly describing why it's better to select multiple parameters and diversify between multiple parameters and not just one. So that's the reason why we also pick this here. So that's our recommendation. What is the conclusion? I would say that our expectations were met. So the margin depth data set can be used to predict SPI's price growth. It can be also used to predict bear markets, and in this case it's better to hold the cash or short-term treasuries. So the effect is most pronounced for moving averages with the lengths between 6 and 12 months. And the optimal approach for mitigating the impact of the possible future mean reversion is to distribute investments equally across multiple periods of these combined trend following strategies. So it's better to be diversified and not just use, I don't know, one parameter, but multiple parameters. I hope that you liked this article. I hope that you liked these analyses. I really recommend you to investigate margin depth data. I mean, they are very useful. They can be really easily used as a market timing predictor, and I hope that you will join me in the next videos. Give us the like, subscribe to our channel, please take a look on the Quantpedia page itself. We have a lot of the interesting ideas, a lot of the trading strategies, a lot of the tools for traders, portfolio managers, etc. And I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.